Okay, welcome to the 2020 Master Trader Program Super Performance Workshop with Mark Minervini being held online. My name is Bob Weissman. I want to welcome you to the second presentation of day 2 of the workshop. A couple quick announcements. Today's sessions, there will be 3 sections. We'll be taking about 5 minutes or so in between each of those sections. With breaks, but we'll be getting started with the first section on page 120 of your workbook, low risk entry point. I also want to just remind you, you do have some options at the top of the viewing screen. There's a view options drop-down box. You can select different options. The default on the zoom ratio is fit to window, I believe, but sometimes it may be better viewing it in the original size, for example, depending upon your device, your screen. Play around with that. Also, just a very, very, very small handful of people having some audio or video issues. But if you do, all you typically need to do is log off, log back on, and that should take care of it. But with the hundreds and hundreds of people that have been here the last 2 days, it is an incredibly small number of you that are having any kind of problems. Very pleased with how Zoom has been working well for this purpose. With that said, I think those were the quick announcements. And for that, let's get started with low risk entry point.
Okay, hello, we're back and we're going to go over timing a low risk entry point using the volatility contraction pattern, VCP, which is my signature characteristic that I look for in virtually every stock setup that I trade. Dave also looks for tightness in price on the right side of the base, which we're going to talk about in depth here. Just to point out, the volatility contraction is a characteristic of a pattern. So it could be a cup with handle pattern, my signature cup completion cheat or load cheat patterns, even power plays and shorter patterns are going to have volatility contraction within them, which I'm going to show you. If you want to limit yourself to the very best setups, you're going to want to stick with stocks that have this characteristic.
And Mark, I would say that this is very, very important in that it shows up. I mean, 100% of the time, 95% of the time before a stock really takes off and makes a great move. I'm looking for this every time I'm going through a chart.
Yeah, and we're going to explain in a little bit here why it's so important, exactly what's taking place during the supply-demand process and why it's so important. But let's take a look at what it looks like and talk about it a little bit for you to be able to identify volatility contraction. So in this example here, this is FSI International. I traded this back in 1995. It made a nice move coming out of this cup with handle. You can see that it comes off the highs, corrects, it comes in 18%, then rallies back, and then comes back again, and only comes back about 5%, and then breaks out from there. So that would be volatility contraction, and it's within, of course, a stage 2 uptrend. I want to point something out that's very important. Everything that we talk about going forward builds on everything that we talked about previously. So nothing negates anything that we already talked about. So if we're talking about a price pattern, well then, if we previously talked about being in a stage 2 uptrend, well then all those price patterns are within stage 2 uptrends. So everything that we spoke about previously is just, you can apply. So we're in the stage 2 uptrend, and now we're looking for that volatility contraction. Here's what it looks like on a daily. So on the daily, let me get my little pointer here. Let's see, get my spotlight. There we go. On the daily, you can see how tight this was. I mean, very, very tight price action here. And then it comes out nicely up a bunch of days in a row. This was a real easy stock to trade and to hold because you could see it never pressured me at all. It just came right out of the gate, had a small pullback and was in new high ground. So I was able to hold it for a bigger move here. That made a nice move. Now, we want to talk about I'm sorry, Dave.
The other thing I would like to add, if you could go back to that, the first chart, go to and you know what you can combine this with is volume contraction pattern too. because if you look at the volume, what is happening during these weeks that is where the price is contracting, well, the volume is doing the same thing. And if you go to the other chart, you'll see it also. I mean, I guess this is the daily, but look what that volume is doing. It's coming down as that's tightening up. So I always see those two go in the hand, and the smaller the volume, I think the bigger the explosion coming up and out of there.
Right. And Dave does this every year. He gives away before we get to that part, but that's okay. But we're going to get to that in just a second.
But we should be looking at this all the time anyway.
Yeah, absolutely. Absolutely. So we're going to talk about the volume in just a second. But yes, volume should be contracting with price, particularly in the last contraction in what we call the pivot point. So we have a whole section on pivot points. So we're going to get to that. So now, the first thing to understand about the volatility contraction pattern is the contraction count, is looking at and counting the contraction. So how do you do that? So you start where the stock peaks and then troughs, and then as it rallies back, each time it peaks and troughs, you're basically measuring those moves and percentage-wise. And again, if this was a 70% decline, that would be too deep, and that would not be a correct volatility contraction pattern. So generally, you want to see these, and it's a function of the market too. If the market's down big, it's in a bear market. These are bear market basis. You might get 40% declines, but usually they're anywhere between 10 and 30 or 40% on that first pullback, and then you start counting, and you can see each time, and I call them T's. I started to call them T's just because I call them tightenings. So I call them T's. This is what I would call a 3T. Okay, let's move on, and let's take a look at this stock. This is where I'm buying this stock. I don't know if I mentioned this before. I can't remember, but 95%, or maybe even more than 95%, but upwards of 95% of all the charts that we're showing you and all these examples are trades that I actually traded in real time at that time and didn't have the benefit of this, of hindsight or seeing what's going to happen like we are looking at now, or looking back and seeing what actually happened. I didn't have that benefit. So it's not like we went and found examples that made our point. These are real examples that were really traded in real time, going back that I didn't even trade, going back into the the 60s and 70s and going way back. Those, of course, we have to look at as precedents. But I've been trading, of course, since the early 80s, so I have a lot of examples. So now, I'm sorry, let's stay here. So this stock here, I'm buying it here, coming right out. You can see 29% is the first pullback. Then the second pullback is 9%. So that's getting right there. That's getting ripe. That's starting to get to a point where I can consider buying it. And then the very last contraction is only 3%, which is really, really tight. That's fantastic. And again, volume is coming in on those pullbacks, and that's what. Yeah, Dave was talking about the volume being very, very low during those pullbacks.
Yeah, only one, and that day actually traded down and closed near the high of the day. Only one day during that whole period. Here's the second. 2 days traded above average daily volume during that time.
Right, and that's exactly what you want to see. And like I said, I'm gonna tell you why you want to see that in just a second. There's a very good reason. There's a good reason behind everything that we're going to show you. So this stock made a very big move in a very short period of time. In 55 days, went up almost 150%. I didn't get the whole move, but I got a good piece of it during that time. Again, it was very easy to hold. It came right out real strong. It was up like 20% in the first few days, and then it just had a minor pullback. So now, taking a look at USG, this is another one I traded. See, very tight. You see how tight sometimes they can get, where you got a 20% pullback, then a 7%, and then a 2%. We're really, really tight in a 2% range. So another thing to talk about, we have a whole section on risk, but just real quick to give you a preview, these tight areas are what we're going to base our risk on. These are technical areas that are going to be important of whether the stock fails or not. So the tighter the base is and the sooner that we can find out that the stock's failing percentage-wise means that we can manage our risk. So, for instance, if we had to, if we had to wait until the stock went down 30% before we knew something was wrong, well, that would be too much risk. I'm not going to take a 30% loss in a stock. But if we can, the stock goes down 3, 4, or 7, 8%, and technically it's damaged, well, then that's acceptable risk. So we back into risk based on the chart. Anything to add there, Dave?
No, and risk is really so important in terms of controlling it. And the tighter the pattern, the smaller the risk you have to take, because it gives you such an easy out point or an obvious out point of where you should be. And lots of times you don't have to wait to that 7 or 8% stop loss that a lot of people use, but because especially when something tightens up and it breaks down, well, you'll know within 3 or 4%, long before the 8%, that it's time to get out of the stock if it's doing that.
That's right. You have a reference point, and now volatility compared to that very tight area in the base is very obvious, as opposed to if the stock was all over the place, well, then volatility would just be normal, and you wouldn't know if it was acting abnormal or not. We'll get into that more later. So another thing to think about here is that how many contractions is in a volatility contraction? Well, you need at least 2. Right? You have to have it contract 2 times. And generally speaking, they're usually between 2 and 4 or 5 and sometimes 6 contractions. I have seen very few that are 7, 8 contractions or more. Usually they tighten up enough where they're buyable within anywhere between 2, like the first example, with FSI International, and as many as 6 or even 7. Like I said, I very rarely see 7. It's usually between 2 and 6. So here's Central Garden and Pet, 10 months up 134%, came out of a perfect base, tightening up. Maybe, another thing to talk about, Dave, is why don't we talk about fractals, where patterns within patterns, when you see these tightenings form and you see the larger pattern shows a tightening, but then if you look within this little pattern, what do we see there, Dave?
Yeah, well, this is not the most beautiful example, but this is one giant, you can say, a cup and handle, where, this, if I could just draw this out, sort of, this is your cup, and your handle is really right in here. And then within that, you get a cup and handle. So that's what a fractal is. It's a smaller pattern within a larger pattern. And you see that over and over again in a lot of very good setups.
Right, there's the little pattern right there. There's your little, there's your little cup with handle within there. Now that's what we call fractals, and the patterns within patterns, and that strengthens the setup. Again, as we're moving along here, I'm going to tell you why that strengthens the setup in just a second here. So let's just take a look and show you some examples. So here's one that corrects your first time, second time. Now it's still way too wide, and you see it comes off again. Now you might ask, well, why not count this one? Well, that's because this one happens afterwards, and you would have counted this in real time. But then when it came up here and then came down again, if this pullback is deeper or the same as this one, then you would count this as 3. It doesn't really matter if you count it 3 or 4. It's not really relevant. It doesn't matter if it's 3, 4, 5. But the main thing is that it's tightening up from left to right, and you can see right here when it gets that last tightening, look how tight it is. I mean, we're talking about, it's fluctuating in just a few point range on a $55 stock, and then you can see how it just explodes out of here, and very quickly you're at a gain. This went up 52% in just 23 days. Just something to point out too, super performance stocks don't necessarily have to go up hundreds of percent or thousands of percent in my book to be considered a super performance. If you get a stock that goes up 50% in a month, that can really add a lot to your portfolio. And if you can compound those, you'll get triple digit performance and super performance in your portfolio very easily. So I'm looking for stocks that move not only large moves, but I want rapid moves. Even more importantly, I want the move to be very fast. I'm fine with stocks that go up 20, 25% in just a few weeks or a month. I can compound those and get to a very large return very quickly. Dave, as far as, for screening, let's talk about real quick why, you know, people have watched us screen and say, how do you go through the charts so quickly? We're just like kind of flipping through them, like bing, bing, bing. I mean, really, really fast. And like, how can you see all that information? Because we're really not looking for all that information just yet when we're first screening. When you're screening, going through charts, what are you looking at, Dave?
Yeah, I immediately, when the chart comes up, I look into this point here. Is the stock tightening up in this last month or so? If it is, or in the last couple of weeks, if it is, then I scan the rest of the chart to see where are we in that pattern, in the overall pattern. Is it in the upper half of the entire range of the chart? And so that's how if the first criteria isn't met, then I go on to the next chart and the next chart until I see this tightening on the right side within the larger pattern.
Right, because if there's no sense in looking at it and examining it very closely, if that buy point isn't close to being set, because it's not actionable. So we're just looking at the right side, and very quickly, if we see some tightness on that right side and we see a nice, coming out of some contraction, then we'll mark it and then take a look at it and then start looking at the fundamentals and really look deep into it. But first, just looking at that right side and looking for that tightness on that right side. Okay, let's talk about why this is important. Why is this important? And this is just the law of supply and demand. There's no magic here. It's not because people are looking at it. It's not the cause, it's the effect. That's what you have to remember. People think, well, if everybody uses a cup with a handle, it's a self-fulfilling prophecy, or if everybody uses it, it won't work anymore. It just doesn't work like that. Supply and demand is supply and demand. And these are just the footprints of supply and demand. Hopefully, after I show you what I'm about to show you, you'll understand that too. So here's what you need to understand. First of all, when you go through a decline in a stock and then you rally back up, basically what happens is you have some people that have bought around the highs. And the sharper and the quicker it moves down that left side, the more likely those people are trapped in the stock with losses. And as the stock comes down and then starts to turn back up off the lows and run up that right side, you've also have some people that are bottom fishers, whether they're value players or whatever reason they're buying around the lows. So now as the stock comes back up the right side, you basically have supply from two areas or two groups of owners of the stock. You have the trapped buyers that are now seeing their stock come back near break even or close to maybe their price that they paid, and they're potential sellers. And you have profits from the bottom fishers that have a nice profit as it comes up the right side. So those two sellers converge, and that causes the stock to now come back down again. But now as you weed some of that supply out, and remember what I said before, everything is in the context of what we previously told you. So these are in stage 2 uptrends, and we're assuming that institutions are in there buying, and they like to buy on pullbacks. A lot of those times they're buying and supporting the stock. So you're sucking up that supply. The larger buyers are sucking up those shorter term players. And as that happens again, it's the same thing all over again, just on a smaller scale. Now, again, you have some people who bought here, the stock comes off and they're trapped, but it doesn't come down as much. So there's not as many trapped buyers and there's not as much profit because the stock doesn't come back as much. So now again, there's less selling and it brings it back a little bit less until finally you have no more supply coming to market. This is a concept that for a lot of people, they just don't understand what supply coming to market means. That's why the volume being very low and the price being very tight is so important and key, especially if it's coming up to an area where it's been turned back a bunch of times and the stock is in a base, and now that shows that there has been supply there. That's been an area where it can't get through and there's supply, there's sellers there. So as you tighten up right into that area, that's telling you, it's giving you an indication that supply has stopped coming to market, and that sets the condition for a very explosive move. So you're looking for institutional volume support, which offers significant buying demand and a supply-demand imbalance. And that's what happens when it gets very tight. When that imbalance happens, now the stock can move very quickly. Let me give you another example, and this will really bring it to life and illustrate it. A lot of people say this really crystallizes the concept. So think about, you know how you get a towel. If you took a towel and you put it in water, if you've ever taken a towel, put it in the water, you pull it out, it weighs a ton. And if you were to wring it out and twist it and get the water out, it would go where almost, all the water comes out and you can't get much water out. So then if you spun up the towel, you unwrung the towel, then turned it again, squeeze it again, more water comes out. And then you do it again. And each time you do it, you just keep wringing it out and then opening it up and wringing it out. More water comes out, but less each time. And if you do that enough times, eventually it's just moisture. There's almost nothing. It's the same concept as you're tightening and tightening and tightening, you're wringing out the supply. You're getting rid of the supply. You're getting rid of the weak hands in the stock, the short-term traders, and the longer term, the bigger institutions now, when they step up to the plate, that stock's going to move. That stock's going to move because there's no supply.
Mark, one other point on this, why this pattern is so important, is that it gives the time, it gives the stock time to rest, because when a stock comes straight off the bottom and almost goes to new highs, there's usually going to be profit taking. I've seen so many stocks that fail if they come straight off the bottom and into new high ground. So this gives, it's almost, to me, it's almost like a runner. He starts at the bottom of the hill, he runs all the way to the top, he's got to catch his breath. And so here, and then here, and here, he's got to take a time, catch his breath, get his energy up, so then he can break out and have another big run. But so many stocks fail if they go straight off the bottom and right into new high ground, because this doesn't occur. This setup does not occur to get it ready to go for the next move.
Right. And what Dave's talking about is something that we call time compression. And we're going to talk about that later, where when the stock comes straight up the right side and you don't give it enough time to develop, fully develop, you're in it premature, and you're risking being whipped around, stopped out, or having the stock continue its decline. And again, remember, like Dave said, these are in uptrends. These are stocks in uptrends, powerful uptrends we're looking for. So again, they may come ripping up from their lows within this uptrend, and then there'll be temporary profit taking. Let's show you what that looks like with Netflix. Netflix in 2009 going into 2010. This is one that set up, pretty perfectly. You can see comes off 27%, then 17%, and then finally, here's the magic number, 8%, which the magic number is single digits. For me, at least, I want to see that last contraction be in single digits, because I want to be able to set a stop at the worst case scenario at the bottom of the pivot, sometimes at the bottom of the base if it's really a very tight base. But I want to be able to, or at least know that the stock is acting abnormal if it takes out those lows. And that, to me, I don't want to have to wait for double digits for that, because I don't want double digit losses. So I try to get into stocks that are only in pivots on the right side that are in single digits.
And now, Mark, the other thing and this is something I mentioned earlier, these patterns, these volatility contraction patterns are patterns that you've got to get ingrained into your mind. So you see this when you're going through charts and you start seeing a stock that sets up like this. This is the pattern you want memorized. So it'll come, again, maybe next week or weeks from now or months from now, you see a pattern exactly like this. You're going to go, man, that looks like Netflix. This is probably going to work.
Yeah, and like Dave said earlier, virtually 100% of the stock prices that explode out of these patterns. You're going to see it over and over and over. It doesn't matter if you go back to 1896, 1903, 1930, 1950, 1980, every single cycle, you're going to see the same thing over and over. Now, Square is a good example, because this was exceptionally tight, even in the first decline here, which, you wouldn't know if you didn't measure this. You always have to measure, because if you just looked at this, you would never know what the percentage is. It's only off 13%. It's only off 13% here. And then the second contraction or the first contraction, but the second T is down 5%. So that's a buy point right there. And then it offers you another buy point here when it's only off 3%. So you could actually do some pyramid buying here, which we're going to cover at another area in the workshop. So again, applying this same principle is universal. Okay. And you can apply it to any stock. It's not like it has to be a certain type of stock, or whether it's a NASDAQ stock, or if it's a conservative stock. You can apply this to every stock, because this is just simply supply and demand. As a matter of fact, it's really timeless as far as the time frames are concerned. I want to show you this little setup right here, where you can see, again, look at how the stock tightens up incredibly tight here, right? And look at the volume. Here's what Dave was talking about, how the volume comes way in, and then as it comes out, you see the expansion in volume. All right, we're going to talk about that too later, about volume, and looking for the contrast between the volume in the pivot and the volume that when it breaks out. But here's the interesting thing about this particular chart here. This chart right here is a 5-minute chart. This is simply an intraday chart. So you see the exact same concept. Matter of fact, if you take a look, that whole setup and rally, excuse me, happened between that area and that area of that one daily bar. So you see, again, if you looked at a weekly, like we looked at on the Netflix chart, or a daily, as we looked at some of the other charts, or an intraday, you're going to see the exact same thing, because this is simply the law of supply and demand. It doesn't know time. Time has nothing to do with it. Now, you'll see, sometimes you'll see up in the corner, I have a little abbreviation. It'll show some numbers and some letters. Now, what I do is I look at the pattern, and I basically count the weeks or the days, and I look at the largest pullback and the smallest contraction, and how many times it tightened, and I make a little note of that. So when I go back and I take a look at my list of stocks, I can right away get an idea of ones I might be interested in. So this particular name right here, you can see it came off 31%, then 17, 8, then 3, right? You can see four T's, right? So this is and it's 40 weeks long. So this is a 40W 31 by 3 4T. And if you were to just take the chart away and just look at it and give it an overlay with depth and width, this is what it would look like right here. Now, again, like I said, you can look at this at a weekly. Here's a weekly, 27 week, 27 by 8, 3T. So the first decline's 27%, the second one's 17, the final one's 8. So now it's ripe. And you can see the volume comes in, and then it comes out nice and strong on the breakout, coming out of a nice, well-formed base. This is the Netflix chart, just on a weekly chart. That's all. No different. Now, again, here's another one, BITA. So this is a daily chart, 8-week, 28 by 6, 3T. This stock went up 465% in just 10 months. That's the kind of stock you want to be in, at least for a portion of the move. But you can see just signature volume and contraction all over it. You see the big volume here on the earnings. They released earnings up triple digit. Stock explodes. But of course, we're not chasing it there. We got to wait for volatility contraction, right? So now it goes through that phase, and you can see when it gets nice and tight on this right side, and you can see the low volume and then the volume on the breakout, that's where you're looking to buy it. Again, we're going to get into the specifics of the pivot point, exactly where to buy, when to buy in a little while. So just bear with us. We're just showing you how to look at the overall pattern right now, but we're going to get into more specifics. The key is to be able to, this is what Dave said before, is to get where you can look at these charts. And if you do this enough and you start to understand what you're looking for, and the reason why I came up with this volatility contraction concept is because I saw so many people looking at chart patterns and they'd say, hey, is this a cup with handle? And it's not even close. So I wanted to enable people to be able to look at these charts and get a better idea of what is a constructive price pattern. And eventually it's almost like you put on glasses and they've got a template in them, and you look at a chart and you're just looking for that, to overlay that template and have it fill in that template. That's sort of what you'll eventually, if you do this long enough, this is sort of what David and I are looking at when we're looking at the charts. We already have an idea of what it needs to look like. Now the chart's got to fill in that template, basically.
Yeah, and the way you get these examples, I mean, you could just bring up almost any chart program, look at the best winners of the last 6 months, and look for these patterns and mark them up and put highlighting on them because you'll see these patterns show up over and over again in these great winning stocks. So the examples of this are easy to find. You just pull up Market Smith or any other charting program.
You'll see it over and over, and you're going to see it within the context of a stage 2 uptrend. Now, you're going to also see them sometimes in the context of a downtrend, but those aren't buys. So remember, first step is stage 2 uptrend. We only want to be involved in stage 2. Remember, stage 1, 3, and 4, you're either losing time or losing money, right? It's either moving sideways, you're losing time, or it's moving down and you're losing money. So you want to be in the advancing stage. Remember, 98% of big winning stocks were in stage 2 uptrends. You want to be in the 90 some odd club, right? Not the 2% or the 5% club. You want to put those probabilities in your corner, and that starts with a stage 2 uptrend. Now, sometimes you get multiple opportunities. Sometimes very early in the stage 2 uptrend, you'll get a very nice, well-formed VCP like you have here in American Superconductor, and get a big move out of it. But you also will sometimes get a lot of different buy points. For instance, right here, you've got Biogen, which set up a nice VCP right here, very early in the stage 2 uptrend, went from a stage 4 to a 1 to the stage 2, right? And you can see this is where all the excitement is, in the stage 2. So you get this first opportunity, then you get another opportunity. You get another VCP here, and then even up here a little bit later, you get another VCP. And I think you talked about this earlier, Dave, where you get multiple opportunities. So if you miss that early opportunity, and Dave, sometimes, right, some of the later opportunities sometimes accelerate even faster because that's where momentum is the strongest.
Yeah, exactly. And that's why I keep a list of stocks that I'm interested in. Let's say a stock that broke out and I was looking the wrong way and it got extended. Well, I'll keep on tracking that for weeks and weeks because, it could be 2 months ahead, 2 months from now that thing sets up all over again and you can get another big move. So never give up on something just because you missed that first move, because if it's a great stock, it's going to go for 1.5 years or 2 years or even longer, and you'll have multiple chances to get aboard that stock.
That's right. And here's Biogen taking a look at the daily. So this is what it looked like on the daily. You can see 5 T's here, bunch of contractions until finally it gets very tight. You see the volume comes in, and then the volume comes strong, coming out. The volume comes in strong, coming out. And this actually emerged on an earnings report. So if you don't get a big gap on the earnings report and emerges out of a base, out of a constructive price pattern on an earnings report, that's fine. That's even all the better if you have great earnings and it's coming out of there. A lot of times, though, they gap and you don't get that chance. But again, this one happened to come out on an earnings report and it didn't really run up too big on the gap. So you're able to buy that. 400, almost 500% in 41 months. A big move. Now, here's another stock here, and this is really, you can see such a contrast in a few things. First of all, look how tight the price is. I mean, it just gets so tight. That's perfect. That's a perfect buy point. And look at the contrast in volume. I mean, this is, institutions coming into this, and you can see the volume really comes in at all the right points and stays pretty below average through the entire basing. And then finally, when it comes out of there, that's where you get that explosive volume. And this took this stock up 81% in just 38 days. Again, that's a super performance move. If you can catch some stocks like this, you're going to grow your portfolio very rapidly.
Yeah, and Mark, I mean, since you mentioned volume, I always like to look at the prior uptrend. As I see this, as the tightening goes on, I like to go back to see if the stock moved on big volume. And if you look over in here and here and here, you'll see that the stock moved up on prior big volume. and then really dried up, as you said, in this box. And you're looking for, you can almost imagine these as skyscrapers versus very small buildings. And then skyscrapers take off again as the stock, or show up again as the stock really starts running.
I love it. You're so metaphoric this time.
Well, no, it's just.
I usually do all the metaphors. You're doing a great job. I'm going to leave the metaphors to you this time around. Okay. Awesome. Yeah. So what Dave is saying too, and is assessing the quality of the stage two. So looking at when we look at a stock, Dave and I both, we look at a weekly as well as a daily, and we're looking to see weekly bars and to see that bigger picture, to see if that stage two uptrend is really looking strong and looks like it's supported by institutions. That's another element of assessing the quality of your setup. So the quality of that trend is also looking at the volume. In any chart pattern or anything that you're looking at with a stock, you want to see up on big volume, tightening up, down on contraction of volume. And you're going to see the exact opposite in a shorting scenario, where you're going to see big volume selling it off and low volume rallying it back. That's just basically a general observation.
Because remember, the big volume, who is the big volume? The big volume is the institutions, the hedge funds, the mutual funds that are coming in and buying that stock. And you want to be looking for their footprint, and that footprint usually lasts a couple of weeks, where they have to take a huge position. They can't buy it in one day, and they're doing it over multiple days. And that's what you were seeing earlier in the pattern of this stock.
Right. Now, what you don't want to see, okay, we're going to show you something that you don't want to see and that you have to be cautious about. And there's a few caveats to this, but you want to be very cautious with extremely deep corrections. So if that first correction that's building that base pattern is exceptionally large, and exceptionally large in my book is 60%, 70%, and certainly any more than 70% is way too large. But if you have, like even recently, we had a pretty big decline in the market. We see a lot of stocks that have very large cups, very large declines in that first decline. That's a symptom of the overall market. And you might need a little more time to build some more contractions to bring out that supply, like I showed you with the towel example. But the key is to measure your stock against the market. So, and then you'll see if it's abnormal or not. So in this particular example in Mankind, you can see the stock comes off 60%, but during that period, the NASDAQ was only down 6%. This is very abnormal. This is a very abnormal action. And while it came rallying back quite a bit, as a matter of fact, it went up 125%. If you were waiting for it to contract and go through a volatility contraction, you might be in for a very, very bad surprise when it gets overwhelmed by supply, because now you've got a lot of trap buyers and you've got a lot of profit in the stock. So it's a faulty setup, and you can see the stock comes crashing in and then goes through the exact same thing all over again. Big, huge decline, rallies back, and once again runs into the supply, and look at how it just gets killed. This is a huge weekly bar, and again, that's not Aunt Betty selling. Those are institutions. Look at the giant spike in volume. That's the exact opposite of what you want to see. Like Dave was talking about, we want to see these skyscrapers, as Dave called it, on the upside, not on the downside.
Yeah, and as you were mentioning volume, right here, you see that big volume spike. Well, what happened? That was on this decline here. The subsequent rally, there was no volume that was even close to what that volume traded on the downside. So I always love to compare how big is the down volume versus the up volume. And if it's rallying on lighter volume than the big spike down, that's a major warning sign.
Right. And then I'm going to use the stamp too. He gets to use the stamp tool.
Yeah, well, you see it there too.
And then you can see as it comes off right here, right? Yeah. I use a little check mark. As it comes off right here, we get zoom. We get all these tools to use. It's kind of fun. As it comes off here, you see the big volume again, and that's larger volume. And then here, it's even larger volume, and you can see how the stock just, completely underperforms and goes from 10 down to 5. And then if you remember how I talked about how much can the stock go down if it's already down 50% or 90%, 100%, right? So again, it goes to 5, but then it goes to 2, right? How much can it go down from 2? 100%. It can go to 0. It can go from 2 to 1 and go down 50%. So it's from where you're buying it. Okay, keep that in mind, bottom fishers. All right, let me take another example here. So here's another faulty base that was very abnormal in Travelzoo. You can see stock comes off 50%. NASDAQ is only down 10% during the same period, comes up that right side. It contracts. It does contract. There's a few other things wrong here that we're not going to get into right now, but we'll talk about later. And then you see how it just comes crashing in, overwhelmed by the supply. And look at the huge volume. That's because that is a faulty base to begin with. All right. It's already telling you that something's wrong in a market that's not that weak. This stock is down 5 times what the general market is down. And then it wedges up the right side, up 75% off the lows. You got a lot of profit taking, and you got trapped buyers in there.
Yeah, Mark, and as you said, it's this 50% correction. A stock has to double just to get back to its old highs on a 50% correction. And I always used a rule, and I continue to use a rule. You mentioned 60%. I always used a rule where if any stock dropped more than 50%, I took it off my list. I wouldn't look at it anymore because it would have to do that. That was only broken. I saw stocks breaking that rule only once, and that was in 1999 into early 2000 when you were in the first internet craze, and stocks would have these huge declines and then run right into new high ground. But that was at a very crazy period. But in most normal markets, when something corrects that much, it's going to take a long time for it to come back.
Yeah, generally speaking, that's my rule too. Once you get even 50% is a pretty big decline that I have to really justify and take a look at the overall market, or it has to have a very large base that gives it a lot of time on the right side to contract many times and really it needs a lot more time. And that can work. But again, we're just showing you how to measure this and to decipher, again, the quality of the base, the quality of the previous uptrend, and then we're going to get into the quality of the pivot and the buy point and the quality of the breakout and the subsequent pullbacks, and just constantly looking at the quality of not only the setup but how the stock's acting to know if we should be buying it and if we should be holding it or selling it or staying away from it altogether. So now, GoPro is one that I love to bring up because I had so many people ask me about this. It was so destined to fail because when everybody I know is calling me about a stock, like Facebook on the IPO, and I can go on and on and on about so many names. Right now, of course, it's Tesla, so beware. Although Tesla is at least very strong, these were stocks that were very weak. This stock is down 61% when the NASDAQ is actually up 10%. I want to talk about abnormal activity. And then it comes back up off the lows and, retraces, I don't know, maybe about half of that previous decline and sets up in a very faulty way, just not a very good look. And as Dave says, a lot of times Dave and I would talk in the daytime, and, I run a stock by him or something, and he'll say, it doesn't have the look. We know what we're looking for. It's a certain looking type of setup and pattern and characteristics. And this does not have the look, and it doesn't have the numbers. It's not supported by anything that, would really make this appetizing at this point. So anyway, this is one that a lot of people were talking about all the way down. Should I be buying it, bottom fishing it? I don't know why everybody loved this GoPro so much. And then when it rallied back, finally it set up here and had a lot of questions about this. And I poo-pooed it and said I wouldn't trade it. And then it collapsed. And, a lot of people are like, well, how'd you know? I didn't know. I mean, it could have went up, but again, the odds are really stacking against it. And this is all about putting the probabilities in your corner and not about certainties, but putting as many probabilities in your corner as you can to be in position to take advantage of something special. So a stock that I traded, Deckers Outdoors, back in 2006, came off of a textbook chart pattern. You can see it tightened up on this right side. We're looking at a weekly here. And then you can see it forms a few other bases, some smaller bases, but viable. And then again, you have here, you have a little cup with handle. And as it gets later and later, you get this much wider, looser pattern. And this is where you're getting late stage, and you start to see, again, that big decline. You see here it comes from 55 down to about 30, so almost a 50% decline. So that's getting a little suspect there. It's a little bit. It's later in the trend. Of course, it's moved from $15 all the way up to 55. It's made a good move, and then it starts rolling over here and moves into stage 4. So you wouldn't get anywhere near that stock, especially once it rolls over. But again, looking at it in the context of a stage 2 uptrend, this is where you get those multiple opportunities to buy the stock.
And here, again, you had the biggest volume that ever traded was a week to the downside. And then you actually had another week. You did have a strong week coming back, but you only had one, and it wasn't as big as this huge week here. Again, combined with a 50% drop, then, or almost a 50%, well, I guess it was a 50% drop, then those are just negatives that stack up too much for this stock to be successful.
Yeah. And again, again, looking at the volume with the price, always comparing volume with price. We're going to get into volume and price very specifically and looking like the microscope. As I promised you, we start from a satellite view, go to an aerial view, which we're pretty much at an aerial view right now, and then go to an overhead view, and then down to a microscopic view. So we're coming in closer and closer here, and we're going to take a break now, and then we're going to come back, and we're going to get even closer, and we're going to look at the pivot point, the exact buy point, and what that right side, the very right side, should look like, and look at volume and price. Like I said, more under the microscope here, or a magnifying glass, and really get more specific. So we're going to take a break here, and we'll be back.
All right, guys, that was the conclusion of Low Entry Risk Point. We're going to take a 5-minute break here, get up, take some time to get a drink, get some food, go to the bathroom, do like I like 10 jumping jacks, get the blood pumping, as we're just getting started with this session for today. Be back in 5 minutes.